Sandra Barnes. She is my mortgage team, and I want you to find out what your beginning steps in getting into the market is, because it really starts with her. So Sandra, please take it away.
Thank you very much, Chaunyce. So yes, thank you everyone for coming, and it's a pleasure to be here. One of the things that I like to say is that it's yes, you can mortgage. So I really believe that with proper planning and pre-planning, that everyone can, find out about how they can qualify for a mortgage and steps that they need to take in order to be able to buy a home. And so with that, I've got the conservative team going to knock at the door again. There they are. My apologies. Yes. So one of the things I like to do is really believe that everyone, if they want, can buy a home. And there's just lots of different options available. And it's really about doing that pre-planning. So whether or not you're thinking of buying in the next 2, 3, 4 months, or whether it's the next 2, 3, 4 years, it's really all about the pre-planning. So, as Chaunyce said, my name is Sandra Barnes, and I am currently working with Dominion Lending as a mortgage broker. Previously, I do have banking background as well, and I did mortgages for 2 major banks as well. And a few years back, around 2014, is when I joined Dominion Lending. And one of the reasons that I came to Dominion Lending was that there was a lot of changes happening, and we knew that there was going to be a lot more coming, and in the industry and restrictions on qualifying. And I really wanted to know that I had lots of different options for our clients. And so being a mortgage broker, that's one of the things that we have. So why use a mortgage broker? So being part of Dominion Lending, we have access to 46 plus different types of lenders. We deal with banks, we deal with credit unions, and we deal with mortgage companies. Sometimes people get a little nervous over what is a mortgage company. Well, a mortgage company, what they do is they lend money and mortgages, but that's all they do. So they don't offer the other banking services. And one of the things you'll find out is that the backing behind these companies usually comes from the banks or pension funds. And you get usually get better terms and better interest rates with these companies. But they are very, very strict. Okay, this is all they do, and it's like AAA type mortgages. Credit unions are great. Different credit unions offer different kinds of products, and we still use the banks as well in many, many cases. One of the things as a mortgage broker, what I do is I'm there to do all the work for you and to help you find the right mortgage that works with you. As a mortgage broker as well, I do get the mortgage, but also too, I work closely with Chaunyce. I work closely with your lawyer. We work closely together throughout the whole process just to be there all the way through. It's not just the one little thing that we do. We want to make sure that we're part of a team and that we are there all the way through. Everybody's on the same team and we're all there to help you. As a mortgage broker, we can do some customized planning. And for myself personally, I've done over $1 billion in mortgages. I've funded over $1 billion. And also too, it's convenient, it's easy, and it's free. So you don't have to run around to each branch. We can do it all for you, and there's no cost to you for that. So a lot of people, many years ago, people used to just go into their own bank, but now a lot of people have tended to switch over to the mortgage broker for all of these reasons. One of the things is the first step, and we've talked about this, is your pre-approval. I know that from a client's perspective, yes, go ahead.
Sorry, are we allowed to back up? We have a question, and it's a great question.
Ah,
And I also
okay, great.
want to summarize and make very clear. Can we talk about the difference of using a mortgage broker rather than your bank? And the question that just came in is, so is there no cost for using a mortgage broker?
So that's a great question. And for the most part, there is no cost. So a lot of times what happens is that in the majority of times, as a mortgage broker, we get paid from the lender that we take the business to. So there's no cost to the lender for our service, or no cost, pardon me, to the borrower for our service. So really, there are some times where there's a cost, and that is, when we talk about the different types of lenders that we have, we also have private lenders and alternative type lenders when you don't qualify at a bank. And when you don't qualify at a regular bank with those type of mortgages, there's often a fee, and they're very specific. But for the majority of mortgages that we do, they're qualified and there is no fee involved in those. Okay. And the difference between dealing with myself or a bank, for example. So every bank and every lender has a little bit different criteria. And they offer different types of terms and different rates. And so what happens is, for you, you would have to go to each bank yourself. And every time you go to a bank, they're also always going to be doing a credit inquiry as well. And sometimes that could impact your credit score. Where if I do it, I do the credit score and then I send, or the credit check, and then I send your credit bureau with the application to numerous different lenders. The other thing is, for me to do it, is that I'm shopping all the different rates. I know all the different little criteria of all these different lenders, and I'll know which ones are important to you and which ones are important for your qualification. So you may have a situation where you want to make sure to have certain prepayment options, or you want to have a certain interest rate. Different lenders have different prepayment privileges. Different lenders have different interest rates, and different lenders also have different lending criteria, which you would not even by a phone call, you wouldn't know. You'd have to apply at each one to make sure that you qualify under all of those lenders' criteria. So it's helpful that if you have one person who can do this for you. And one of the things I say in the first, for the first steps, of course, when people call me, is they really want to know, how much do I qualify for? Second question, or sometimes it's reversed, what is your interest rate? So those are the two criteria that the client has on their mind. Okay, how much do I qualify for, and what's your interest rate? One of the things I like to do is, I always say pre-planning is key. So coming and doing this first, not at the end, and going through all the process is, I think I'm the host, so there's someone here, Christina, who wants to be admitted. I'm going to go ahead and admit.
Yes, please.
Okay, great.
Sorry about that.
Yeah, that's okay. So, yeah, so pre-planning is really key, because one of the things we want to do is we do want to check your credit, because there could be something on your credit that might be a problem. Also, too, learning about everything ahead of time. And I always say, it was great that we heard all the different things from a lawyer's perspective. And then there's some overlap on what I do as well. But a lot of it sometimes can be overwhelming. So the more you hear it, the more times you hear it. If you hear something 3 times, finally, it all starts to come together. And that's part of us all working together as a team too. We kind of do a little bit of crossover. We have the specialists, but we also, we have a general idea about what our other partners are going to be asking you and looking at, and questions you should speak with to your lawyer or to your realtor about, or to your mortgage broker about. And it's really nice that we work together. And when we do this pre-planning ahead of time, it really helps you to understand the whole process as well as we work through. What I like to do is have a conversation with the client. So this is a little bit about what I do and how I operate. So for example, Chaunyce will refer a client to me, and I will then make a phone call out, and we'll have an initial conversation. And what we like to do is have a very high level conversation. I find that, as I said, the first thing that a client wants to know is, how much do I qualify for? And I like to find out also too, when we're in this initial conversation, a little bit about your wish list and your long and short-term goals. And with this bit of information, it helps me as well to have an idea. So for example, we've talked about this a little bit already, as land transfer tax. So when I'm working with you on this initial call, I would like to find out, what's your wish list? Where would you like to buy? So are you in the 416 or the 905? So I'm kind of keeping this in the back of my mind so that I can work the land transfer tax into the equation when we're talking. We want to make sure that we've got enough money, that we've kind of covered off a lot of things. So all the questions we ask help us, or help me, to actually come up with a good pre-approval for you, and making sure that, I have all the information, and I can make sure that the pre-approval matches your wish list. The other thing is would it be a condo, or is it going to be a freehold? Because condo fees have to be included in the pre-approval amount. So these are things that we have to include. And at this point, we're estimating them. So these are questions that will come across in order to give you an idea as to how much you would qualify for. I also then go into some high-level details. So we cover, kind of the wish list, the goals, and then high-level details. What's your income? What's your employment? So are you full-time? Are you guaranteed? Do you have any variable pay, such as bonus or overtime? These are questions that I ask, because when you ask me how much am I pre-qualified for, you can tell me how much you made last year. But if that did include bonus, we need to have a 2-year average. And if I don't dig deep and ask you those questions, I may just use, what income you said. And in the end, if there is variable pay, they may end up cutting back your pre-approval amount if we haven't done the 2-year average. So any variable pay must be verified for 2 years. And that's really important. So these are the questions we ask. It also helps me to ask these questions in our high-level conversation, so that when I go to ask you for documentation, I can ask you for the appropriate documentation in order to back up what you've said. So if you're on salary and there is no overtime or bonus, then all I really need is, your current information. We don't have to do the 2 years backwards on that. We also cover off down payment and closing costs. So again, here we want to make sure that you have down payment available to you. How much down payment do you have? Your income may be such that you qualify for, a $900,000 mortgage, but if you don't have minimum down payment required, then your mortgage pre-approval would get cut back. So these are things. So we want to ask these questions so that we know that we are looking at the whole picture and being able to give you an accurate pre-approval amount. We also talk about other debts. Yes, go ahead.
Can I say one thing really quickly? It's so important that you mentioned maintenance fees and property taxes and that sort of thing. I didn't actually mention it earlier, and I don't know who was on this kind of seminar when we first started. But as I was laying out what the process looks like, it's important to note that your team, your mortgage broker, your realtor, your lawyer, they really should be connected. Because at which time I then jump back to Sandra when we find a house you like. And I'm like, hey, Sandra, here's the specs on the property. Here's the property tax. Here's what we're thinking of offering. Here's the maintenance fee. Is there any other special things that you should know about the property? And she'll run all the numbers for us to let us know where we stand. So just wanted to make sure to put that out there as well, that we are very much connected and we are a whole sphere behind the scenes working for you. So yeah.
Exactly. And so yeah. And that's a really good point, because one of the things we do is what I do when I do an estimate for someone with regards to how much you qualify for, I will say, now it's really important that you understand that I've used the figure of $4,000 for your property taxes, and I've used $500 for the maintenance fees. When you're going out looking at listings, if the taxes are less, that's great. If the taxes are more, you're going to want to give me a phone call. If the condo fees are less, great. If the condo fees are more, give me a call. It doesn't mean 100% that it doesn't qualify. It just means that these are the figures that I was using. Okay. And yes, really important to work together, especially on those on condos, because the condo fees can have a really wide range as you get out there and start looking. So really good point of us, how we work together. The other thing I want to say is that we also look at other debts and credit history. So high level, what are your car payments? What other credit cards do you have? These kind of things, because that also impacts your qualifying. So there's a lot of things that really determine how much your pre-approval is going to be for. The other thing is fixed versus variable. Now, I usually don't get into that too much in the beginning. We talk about fixed rates and we talk about variable rates. And I ask you to, just keep your eyes and ears open for it. Here's a little general information about the difference between fixed and variable. And think about it, and we come back to it later, because no decision has to really be made on which term you're taking at the pre-approval stage. We can kind of talk about it a bit, and you can think about, which one you're more comfortable with. And the other thing that I always like to say as well is that what I pre-approve you for may be different than what you're comfortable with, because we're allowed to pre-approve you for this amount, but you may want your monthly payments to be less. And so that, again, where we're working together to make sure that everything is comfortable. So if you tell me that you only want your payments to be so much a month, because you know how your expenses are, you know how much money you net every month. And if you only want to spend so much, we will adjust your pre-approval according to that amount. So a lot of things come into the pre-approval process, for sure. And then also too, I'm just going to move this over here. Once I gather this information from you and we start to put the story together, then I have to apply it to all the internal qualifications that really are the behind the scenes. That is, what is your loan to value? So do you have 20% down or less than 20% down? That really determines your pre-approval amount as well. So there's something called a high ratio mortgage and a conventional mortgage. So conventional mortgage is when you have 20% or more as your down payment. High ratio mortgage is when you have less than 20%. So I'm going to give you a quick little scenario on that. the banks have rules, and everything that they're allowed to do is in the Bank Act. So the Bank Act says, hey, banks, you follow these rules and you're allowed to lend out on mortgages as long as clients have a 20% down payment. The government realizes that a lot of people do not have 20% down. So they came up with a solution which allows people to get into the housing market without the 20% down. And that is called a high ratio mortgage. And the banks have to go and get insurance on the mortgage. And that insurance is called a high ratio insurance, a default insurance. And I like to tell people that this insurance is not for you. It is really for our whole banking system and for the depositors of the banks. So people deposit their money and the banks turn around and lend it out. So if you don't have 20% down, you must get your mortgage insured. That insurance means that if for whatever reason that there was a default and the bank had to sell the home and they sold the home and there wasn't enough money to cover the mortgage and the arrears, that the banks will not have to pay that shortfall. They're allowed to put a claim into the insurance company. Now, that is really, really super important in the pre-approval process. The reason is because under a high ratio mortgage, you can only have a maximum of 25-year amortization. So this means that your payments will be a little bit higher than if you had a 30-year amortization. Maybe a little confusing. We can work it out in more detail afterwards, but it's really important to, bye-bye, Svana.
Sorry.
See you later.
Thank you for joining us.
So sorry, I didn't mean to interrupt.
That's
So sorry,
okay.
but I have to run.
You run. It was great
Thank
chatting.
you.
Okay,
Thank you, everyone. Thank you. Take care, everyone. Bye-bye.
Bye-bye.
Bye.
Yeah. Okay, so the high ratio mortgage is a little bit harder to qualify for. The reason is that you have to have a 25-year amortization. And what happens with a high ratio mortgage as well is that there's an insurance premium added to your mortgage. We do that automatically when we're doing the calculations for you. So we do need to know how much your down payment is. So here's the little rule for the minimum down payments. It is minimum of 5% of the first 500,000, 10% of the balance, and the purchase price cannot exceed 999,000. So an example of this would be if you were buying a property for 700,000, your minimum down payment is 5% of the first 500, which is 25,000, and then 10% of any value over the 500. So if you're buying for 7, we would minus off the 5, and now we have 200,000 left. So 10% of 200 is 20,000. So on a $700,000 purchase price, your minimum down payment is 25 plus 20, so 45,000 is your minimum down payment. And then you have to have the closing costs as well. All of these are just examples for you right now, but everyone's circumstance is different. And these are things we work through on that initial phone call. There's also something called a stress test. And this means that although your rate might end up being, 4%, or it might end up being, I'm just trying to think of, maybe it might end up being 3.2% if you went with the variable or something along those lines. No matter, even though your rate is lower, you must qualify under the stress test. And the stress test currently, it's always set out by the government, currently is your contract rate plus 2% or 5.25%, whichever is higher. So those are numbers we have to work out as well when we're doing your pre-qualifying. GDS and TDS, these are our internal little formulas: gross debt servicing, total debt servicing. So we must take principal, interest, taxes, and heating, and half your condo fees, and figure out how much that is in a percentage to your income. So they like it to be around 39% of your gross income. And the total debt servicing would be principal, interest, taxes, heating, tap, water fees, and any other payments that you have cannot exceed 44% of your gross income. So these are little formulas that we're doing along the way. And then the other thing is your the property that you're going to buy must also meet all their criteria. So for example, if you're buying a property with a smaller square footage, that could be an issue. So you want to make sure that your property, that we're also, again, going back with Chaunyce on the listing and kind of double checking and making sure everything is matching up and everything is good. So these are things that we like to do, working through the process with you as you're looking at different homes. Yes.
Very
Chaunyce.
quickly, because I have had this circumstance. Why buying a smaller home might that be an issue for a lender or for the mortgage?
Yeah, that's really, really important. And here's what they say. And I actually use the word here. It's property marketability. So if you were to buy a smaller type home, there are less people who would like to buy that home afterwards if they had to sell it. So they want to make sure that it's kind of like an average type home that most people would like to buy. So an example would be student housing.
Mm-hmm.
Student housing might be an issue because only students will buy that, right? You're very limited as to who would like to buy that property. I had a client just buy a home and a condominium, but it was under 500 square feet. Now I get that. My one lender that I went to, their minimum is 500, and I get that exception all day long when it's with a condo. But we still had to make sure to go in and get the exception. It's not I'm not authorized to give it. We have to go to the lender, and the lender has to give it. So these are little things that we have to, be mindful of as we're working through and doing offers and working together on them. Yeah.
Incredible. Can we slightly fast forward? I saw a line here that really stood out to me. I know this other debts and credit history is a conversation that's usually had in the beginning phase of you guys getting the mortgage or solidifying what your numbers look like. But can we also just touch upon something you don't do before closing regarding debts and credit history?
Absolutely. So thanks for bringing that up. I know we were talking about it earlier as well, so I appreciate that. So here's the thing. So I'll just fast forward a little bit here too, is that when I'm talking to a client, I kind of go over all of this with you. And then we take the next steps of, does the pre-approval sound good to you? Are you comfortable with the monthly payments? Are you ready to take the next step? Because the next step is when we go to formalize your pre-approval amount and get you some rate holds at different lenders. Okay, and that's what we want to do as well. That's part of the process is if we can make sure you're qualified, hold some rates for you because rates have been going up and we want to make sure to hold a rate for as long as we can, which is usually 120 days. And that's when you say yes, after our conversation, then we start to follow up with documentation and we start to go through a very formal process. So we will actually pull a credit history. We get your authorization to do that. I personally never pull a credit history unless you've given me written authorization. I just say I personally, because not everybody does that, but my policy is must have written confirmation on file. And then we can start to formalize this. And that is when we have a whole list of do's and do nots. Okay. So one of the things we have a lot of do nots. We do not want you to change jobs in the middle of a pre-approval process. We want you to stay where you are until you actually buy and move in. Sometimes there are circumstances, we do have some lenders that are a little bit more flexible. Yes, go ahead.
Sorry, can you just repeat that? We want you to stay where you are. Like, do not make any big changes to your life from your pre-approval until you move in. Okay.
Right.
Proceed.
That's it. Yes. So, and that includes not going out and buying a car. That includes not increasing your debt on your credit cards or your lines of credits. That includes not changing your job. Just keep everything the way it is. The other thing we don't want you doing, so one of our toughest conditions that we have to meet is the down payment verification. And you may think it's very, very simple, but it is our toughest condition because they're looking for anything that is anti-money laundering. So yes, we want to make sure that it's from your own resources, but also to anti-money laundering. So if you start transferring money from one account to the other, we have to get 3-month history on all your accounts, and we have to verify every single deposit that was made. So really important to keep really good records and keep them as clean as possible. Here's an example. You have money sitting in a TFSA and you decide you're going to start to consolidate because you're going to buy a house. So you go and you take out the money out of your TFSA and you close down the account and you put the money into your checking account. Now we have this deposit that went into your checking account, but you've closed your TFSA and now you cannot get records. And the banks need to have the full 3-month history of all the records. That would be an example of a challenge for us. So we like everything to stay exactly the same. I had another client who sold a vehicle for his down payment. So he sold the vehicle and he didn't keep any records. So we have $5,000 popping into his account. It's like, where did it come from? Did you sell some drugs to get this? And it seems, maybe a little daunting, but just make sure that every deposit you have verification. Okay. Yeah.
When it comes to not changing things, so meaning not buying, okay, I found a house, let me buy all the furnishing and everything to furnish the house on credit. Why are we saying don't make big moves? Don't change your jobs. Don't change your credit history. Don't use your line of credit in between purchasing and closing. Why? What will happen if you do some of these things?
Potentially, and we have had it where all of a sudden, because you've gone out and got another car loan, all of a sudden you no longer qualify. You've gone out and run up another credit, and that credit has lowered your credit score. So maybe you still qualify because of the debt, but because you did that extra credit inquiry now, it's lowered your score and you no longer qualify. We had somebody who stopped paying all their debts. And all of a sudden a credit check was done and they stopped paying. It was like, you can't do things like that. And so we couldn't get a mortgage for it. It wasn't mine, it was someone else's, but it was still a story where, that's what they did and the deal couldn't close. So it's really, really important just to, have good communication, and it's really one-on-one. I have clients call me up all the time if they get a job offer, and we talk about it. We talk it through and we decide which lender we can go to if you really want to take the job, and how is it going to impact. When will we need the closing date to be? Because we have to make sure there's, a couple full pay stubs in before closing, these kind of things. So it's not to say that some things can't happen, but it's really important to have those conversations before you do anything with your mortgage broker. Okay. The other thing that, go ahead.
Thanks so much. Thanks for clarifying.
Yeah. So a couple of other things that I just wanted to talk about briefly. We've already talked about insurance twice now. And we actually talk about insurance about 4 different times throughout the process, all meaning something totally different. And this is not on this screen, but I just want to talk to you briefly, high level about it. We'll go into more detail later. But we talked about the CMHC high ratio insurance. We've also talked about title insurance, where you get that protection. There's also going to be life and disability insurance as well that you get to have an opportunity to take when we're doing the mortgage. The other insurance that is mandatory is is house insurance, fire insurance. So house insurance is going to be mandatory when you buy a property. High ratio insurance is mandatory if you have less than 20% down. Title insurance is going to be mandatory when you get over to the lawyer's office. Life and disability insurance is a really good benefit and package to have, but it's not mandatory. But we will discuss it, and you can, make your decision on it. So I just wanted to throw that out at this time as well. The other thing I want to talk about, I talked about down payment being, the minimum down payments, and I talked about it being one of our toughest conditions to meet. But I also want to talk a little bit about different forms of down payment. So down payment can come from your savings. It can come from your RSP. You can withdraw if you have money and you're a first-time home buyer. And first-time home buyer, by the way, the qualification for a first-time home buyer under the RSP rules is different than the land transfer tax. So you actually can be a second-time home buyer and still be able to withdraw money out of your RSP sometimes. So again, if you have a marital breakdown and you had a divorce from your last property, you can actually, there is some opportunity for you to take money out of your RSP again. If you had owned a property as your primary residence, 4 or 5 years ago, about 5 years ago, really, then you can also requalify again to take money out of your RSPs. So there are some opportunities for that. So you can use your RSPs, you can use your TFSA. As Chaunyce was saying earlier, there's been a new announcement that they're going to come up with $40,000 tax-free savings for first-time home buyers. We have no details on that. What we do is we know is that that's been kind of pushed off till 2023. So that's one of the things that we don't have the information on quite yet. But it will be coming. The other thing I like to talk about is different ways that you can come up with a down payment. So there's government RSP for the first-time home buyer. So that is where you can withdraw up to $35,000. So if you have a partner, both of you can withdraw up to $35,000. You can also maximize a little bit. If you're, depending on when you're going to buy, you can actually put money into your RSP and get a tax rebate as well to help you. So tax rebates obviously come next spring, March, April, in around then. But that is something that you can also use your tax refund to help you build up for your down payment and your closing costs. There is a program which I'm not going to go into too many details because it's a little bit, it has its criteria as well, but there is a government shared equity program. And the government shared equity program, you put in 5% and they can put in up to 5%. And so now you have 10% for your down payment. The government actually owns 5% of your home, and you have to pay them equity when you go to pay them off down the road. But for some people, it can reduce your mortgage payment by a couple $100, and it can make the difference between qualifying. So it is something, it's not a perfect program, but it is something that works for some people. I'm glad to have a one-on-one with that program and see if it works for you. Some lenders allow you to borrow the down payment. So for example, if you have high income, but not a lot of down payment, maybe you can tap into an unsecured line of credit and be able to use that for your down payment, as long as, you know, it meets all sorts of other criteria as well. The other thing that's really important to know as well is that we've talked about this, is that a first-time home buyer can qualify for the land transfer tax rebate. So you maybe don't have to have as much for your closing costs. The other thing to know as well is that you will get if you're a first-time home buyer, there's an RSP tax rebate that you will get. As I was saying, your tax refunds, if you put money into your RSP, you're going to get a nice big tax rebate, and that can go to help with your down payment. There are some lenders who will offer some cash back on mortgages. So you pay a little bit higher interest rate, but you get some cash back. That cash back usually can't be used for down payment, but it can be used to go towards your closing costs, which, you know, can be substantial and start to, you know, increase on the amount of funds you need for closing. Gift money, bank of mom and dad, happens often. So there are some restrictions with it. Has to be from immediate family, but there is lenders will consider gift money from parents. And one of the things I like to say, I do really talk, you know, pretty open about the gift money, and you know who it's intended for and things like that when we're doing one-on-one. So parents can sometimes give gift money. Some parents do not have, a lot of parents do not have maybe, you know, money sitting around available, but they might have a line of credit on their home or an unsecured line of credit, and they can tap into that in order to give the gift. So that's just something to keep in mind as well. And I also have a dog, by the way. You could hear the dog in the background. The other thing that is coming more and more is co-ownership. So for example, right now, you know, it's hard to save the money for a down payment and hard to qualify for the mortgage. But a lot of times two friends now are buying their first home together. And so that's something we're seeing a lot as well, and something that you can consider as you move forward, if you're a first-time home buyer. So the next steps after that, of course, is to go ahead, you know, kind of figure out what it is that's important to you, match it up with your pre-approval, talk to myself, you know, your mortgage broker, and make sure that we communicate this information to your real estate agent, to Chaunyce, and we start to take the next steps, and that's securing the rate for you, following up on the documentation, making sure that we've dotted our I's and crossed our T's, and then working closely with you with the properties that you're going out to look at. If you find ones that you're thinking of putting an offer in, making sure to, you know, reach back out, and we'll just do numbers. I do it all the time. I'm available on weekends. I'm available in the evening, because that's a lot of times when you're seeing these properties, when you want to make the offer. So we'll actually take that listing. Chaunyce will send me over the listing. We'll do the numbers, and we'll make sure that everything is really good before you make that offer. Chaunyce, I know that in the past, all the offers were usually with no conditions on financing, because it was such a different market.
Yeah.
Right? And sometimes you still have to do that. But sometimes now we can put the condition of financing in. All banks are going to tell you that you have to put a condition of financing in. And even with all the people in the past who went infirm, all their banks told them that they had to put a condition of financing in. So what we do is, again, it's about working very closely together so that we can look at all the best case, worst case scenarios. And if you have to make an offer that is without a condition, that we've really examined worst case scenarios. We've all worked together, Chaunyce giving you worst case on the value of the home, me looking worst case with the application. And overall, we make sure that you are going to be protected as best we can.
Absolutely fabulous.
And I know it's really late. Thank you for staying on for so long. We've covered a lot tonight, haven't we? And if you have any questions, you can always, I don't know, is there any questions in the chat, Chaunyce?
Not
Or are
as
we
of
good?
yet. Does anyone have questions? Sandra, you don't, strictly up to you, don't have to stay, and I know you guys have been super patient and I'm so grateful for your time. You guys let me know how you feel, because I can also do a really quick screen share. And what I mean by quick is I mean like 5 or 10 minutes. Share my screen with you, show you what I see in the market, and kind of show you what properties, what price points are like for specific areas. If someone has an interest, I can do that as well. And you could be like, okay, this is the area I'm interested in. What do you got? So not sure if you're interested, but I can most definitely do it. Thoughts, comments?
I have a question. Can I just jump in?
Yes, question. Let's do questions right now. Absolutely.
Okay, good evening, everyone. It's been a great presentation. Thank you for this opportunity. It's encouraging. I'm just going to be real. I never thought that I'd be one to be able to purchase a home, but have that great desire. So at this point, would you suggest then, Sandra and Chaunyce, should I just sit and just, I don't know, twiddle my thumbs and stay discouraged, or just say, okay, Sandra, I want, like, let's build up a plan so we can at least get to that point and not just try and struggle and like, okay, let me work on my credit. Let me do this. Let me do that first before I go visit Sandra. You know what I mean? Like, some people want to get everything correct first and then make that step. Or should I try and, step out on faith and, see what exactly I need to get to that point?
So that's exactly it. So what I think is most paramount is, even if you don't think you're ready, you never know. So what you're going to want to do is reach out. I can connect us. You go to Sandra and be like, hey, I don't really know where I stand, but can we run the numbers so I know? Even if Sandra comes back to you and she's like, maybe we can work on a credit, or maybe she'll come back to you and be like, you're perfect. What do you mean? You're able to get into the market. But at least then you can start building a game plan and be like, okay, if I fix my deposit amount or my credit or whatever, then I would be eligible. At least you know where you are with a starting line. Sandra, how do you feel about that advice?
100%. I personally believe that it's never, so you'll notice that one of the things I tried to say a few times throughout what I was saying is it's all about pre-planning.
Yeah.
And it doesn't matter whether it's 4 months or 4 years. If you don't do the pre-planning now, in 4 years, you still won't be ready.
Yeah.
So there could be multiple things that are a challenge, and that's okay. But we'll go through the process and I will tell you, in detail, according to your circumstance, what you need to do, and how we can do it. And you'll notice that I also brought up, sorry, my throat's dry.
Okay.
I also brought up about co-ownership, because co-ownership is really, a lot of people, like my son, he makes really good money, but he has student loans and he's just starting out and everything's so expensive. So for him, he's even looking at buying with his friend.
Mhm.
so that they can find a way to get into the market. And he makes half decent money, but even with the money, when you have these student loans and you have different things and, it's challenging. So there's a lot of different things that people can do. And you might not know someone that you could be co-ownership with now, but as you work through the process and you start to think and put it out there, your mind becomes open that when you may meet a cousin at a family reunion, and say, hey, I'm in the same boat. And the next thing you know, you buy a place together, right? Maybe you end up buying, an investment property together. There's so many different things that you can come up with and ideas, but it's really about finding out what's available, how would it look, what would the monthly payments be, things like that. I just did one for 3 people who bought, and they were actually co-workers.
Mm-hmm.
Okay, and none of them could afford on their own. So 3 of them bought together, and they bought a condo, and they were able to buy an $800,000 condo because all 3 of them came together. And it gave them, wherever they bought, they were able to get the 3 bedrooms, and it worked. So there's a lot of different scenarios. I have friends who are, thinking about how they're going to retire. Well, you know what? And about living together and working together, because as you get older, you want company and things like that. So, yeah, everyone's got a different circumstance. And I think starting the process, first of all, looking at the credit, letting me tell you, let's say, for example, there's problems with the credit. I can give you ideas as to how to improve it, where you may not know. Right? Like I can say, okay, do this and this one will increase. Do this and this one will increase. Sometimes we may look at the credit and say, you know what, that's going to drop off your credit in a year. You may not want to touch it because it's on its way off. As soon as you touch it, you get a date last active, and now it's going to stay on your credit again for 3, 4, 7 years, whatever. So sometimes you just don't want to touch them. You want to just let them fall off. But it's about reestablishing credit. All these things that the lender's going to look at, I can at least give you guidance on it. There's everybody's circumstance is different. I don't want to just talk about credit because everyone's circumstance is so different. Does that make sense? That was Monique that was speaking, right?
Yes, it makes excellent sense. Thank you so much.
You're welcome. And I noticed someone else said you were in this, Christina, you said you're in the same boat as well. So same thing, there are so many people in the same circumstance. At least start by having the conversation and getting a plan. Without a plan, you won't end up there. So, but with a plan, you can buy a home down the road.
I think that's the most important thing as well, is because if you don't know your situation, if you don't start getting the ball rolling, then you won't know where you stand. So even if you go to Sandra and Sandra's like, you probably might want to partner with someone, and you're like, I don't know anyone. Then your mind starts rolling. You may not need to partner with someone, but finding out where you stand is like the most important thing that you can do.
Yeah.
Does anyone else have a question?
Good question.
Mm-hmm. No other questions?